Hey, folks, welcome to the Breakthrough Advisor podcast. This is Jack Martin. I'm the virtual CMO for InsureMark. I want to welcome you today. Thanks for taking time out of your busy schedules. We're super excited to have Patrick Kelly with us. You've probably seen his books on Amazon. You may have heard his webinars, heard him talk before. Patrick Kelly, welcome to the Breakthrough Advisor podcast.
Thanks, Jack. It's good to be with you today.
Hey, for the one or two people who are listening who haven't heard of you in the past, so tell us a little bit about your background. What's your origin story? How'd you get here?
Yeah, well, it's probably not too dissimilar from many of theirs, although I've done it for probably a longer period of time. I have been a producer in the insurance industry since 1993, so I was one of the real early original ones. I came right out of college. I was actually uh, kind of, as most of us, I think, have found ourselves in insurance. I don't know many people that when they were in high school and they said, "Hey, what do you want to do when you grow up?" They said, "I want to be an insurance agent." Um, we kind of found it through the back door, and I was working on a master's degree, being newly married, and I started working for an acquaintance I knew in the business, and his management just kept tapping me on the shoulder back in 1991 and saying, "Hey, we think you'd be a good fit. Would you like to do it?" And I said, "Nope." And after about 2 years, I finally said, "Yep." And so I've been a producer since January 1st of 1993.
Well, congratulations. Way to
Yeah,
go.
thank you.
Yeah, I think maybe you're at the very tail end of the father knows best era, when they used to carry briefcases and go door to door and talk
Yeah,
about life insurance, right?
yep,
So so a lot of folks will know you from tax-free retirement. I mean that's kind of, your mantle. That's kind of
yep.
where I think a lot of folks come across Patrick Kelly. So tell us, just a short bit about, what's entailed when we talk about Patrick Kelly and tax-free retirement.
Sure.
What is, give us the short story there.
It's been a fun evolution. Interestingly enough, obviously, for those that know the book, Tax Free Retirement, that term started as a book title back in 2007. And I'll tell a little history of that because I think it's important and pertinent to what we're talking about today. But it's been interesting to see it evolve over the last 17 years to where it went from a book title to kind of a general noun. You hear people talking about, "Hey, I have a tax-free retirement plan," or something. And so it's been fun to watch it. And, I think it's become a talking point in the industry, not, far outside of my book. And the thing that was interesting on the book, and I think this is why it's pertinent to the story, is back in probably 2003, 4, 5, a couple years before the book was published, I was, for years, I was talking about this strategy with clients. And the one question I would get, and maybe the question advisors still get today, although it's a little bit more well known, is, "Patrick, if this is what you say it is, if it's really this good and it's been around this long, how come I've never heard about it?" And so I went to the bookstore to find a book that I could give to them that could explain and validate what I was telling them. And I couldn't find a thing. There was nothing. And a little tidbit about me, I was a writing major in college, so I like to write. I did not ever think I would write a financial book. I kind of had my dreams and probably still do a little bit on the great American novel. But I set out and I said, I'm going to write this book. Well, I didn't know what I was going to write. I was going to write something. And so for 2 whole years, I had that book completed. And there's another funny little addendum story to this, but I had it completed. And as people would come in and visit, I would actually hit print 172 pages on my word, on the Word file, 3-hole punch it, put it in a notebook, send it home with them. And that's for 2 years how that book existed. And people, most of them really appreciated, they understood it better after reading that. But there would be a few that would say, "Well, Patrick, of course, you wrote the book. You're the one telling me this story. You wrote the book. You're going to say the same thing. I want someone third party." And so I think what I did is I went out to some advisor friends of mine and gave it to them. And they're like, this is exactly what we need. And what's interesting is they found it more beneficial for their practices than I did for mine, because I was their third party voice. And so the little side, rabbit trail addendum story is one of those advisors, though, that had written a book. He told me, this is terrible. It will never sell. You should scrap the first 16 chapters. No one wants to hear stories. No one wants to hear about this. They just want to know how. And so that one person's voice caused me to sit on this, because I had to give up about half of my income. I had to give up my securities license to print it, because it became marketing material. And so I had to, for 2 years, wrestled with the question, do I give up half of my income for something that someone tells me won't sell a copy? I had, 49 voices that were positive, but that one negative voice caused me to pause. And I finally decided, you know what? I can get the securities license back. I'll never know. I believe in this. I believe in the story. The story needs to get out there. And so obviously the rest is history. I decided to publish it in 2007.
Yeah, boy, that's a great story. I think for all of us at the level of if belief is a powerful thing. If you believe in something strong enough, you can make lots of good things happen.
Yeah.
So let's fast forward now to 24, and we're talking about a scenario where government deficits are out of control. Where we're still relatively at historically low income tax rates, and so we know for sure in 26 we're going to get a little pop on the marginal rates, right? And there's going to be a lot of pressure from that point going forward. So if I'm a financial advisor today, and I look at my menu of choices, I've got taxable accounts, I've got tax deferred accounts, I've got tax free accounts, I've got tax free municipal bonds, I've got Roth conversions, I've got life insurance. So where does the tax free retirement account, and that's where we're talking about using life insurance, right, to create tax free income.
Yep.
So where should I think about that as fitting into my client's retirement income plan?
Absolutely. I mean, I think, as you know, it's going to vary from client to client. There isn't really a set percentage or a set, even thumb, nail rule. I think a lot will depend on their disposable income level, but I would say this, and just to be clear, like you said, I want to reiterate, I didn't create a new plan. This is simply using and utilizing the structure of today's life insurance to be able to put away money. And most people, or I'll say a lot of people, like to buy their life insurance what I call backwards. Not really backwards, but I'll just title it that. Meaning they like to get the most amount of insurance for the least amount of money. And what this structure does is it says, let's get you the proper amount of life insurance. That's the right amount, whatever as an individual you need. But the government says, or the company says, there's a minimum amount you have to put in. But the government says, hey, we know this is really a tax advantage structure. We've granted these tax laws to it. And so because of that, we're going to cap how much you're able to put in. And the delta, the difference between those two numbers, the vast majority of all of that premium goes into an individual's account, into the life insurance cash value. And in the policies we're using today is going to experience growth when the market is growing, but not have any risk of loss when the market goes down. And so I say all that to really answer your question, where does it fit in? In my experience, most people need life insurance, certainly if they have a family. And so if they're buying the life insurance anyway, there's really not an additional cost because they're already paying for the cost of the insurance based on just buying it like most people do. I need this amount, and here's what the company is charging. So now we're really, if that's your case, if you're listening to this, then really the extra amount is going to be fairly similar to what you might then put into, say, a Roth IRA or something along those lines. By the way, this isn't the only place to get a tax-free retirement account or structure. Roth IRAs offer it. Roth 401ks offer it, municipal bonds offer it. The problem with those is many people don't have access to a Roth 401k. And if they have access to a Roth IRA, number one, if their income is too high, they can't participate. Number two, they can't really put that much in. And so, what I think the life insurance does is it steps into that gap. And I'm not an all or nothing person. I think having money in all of the different buckets is really a good thing because we don't know what tax rates are going to do. Now, we could spend a whole podcast, Jack, talking about what I think they're going to do because of where the debt and the deficits are. That's a subject you probably know I'm very passionate about. But if someone has money in a 401k and money in a structure that they can access tax-free, then when the time comes for them to access the money, they get to choose. Is it a low tax rate environment? Great. Well, let's pull it from the taxable, money, the one that we've put away tax deferred. Is it a really high tax rate environment? Well, great. We now have this vehicle over here that we can access and pay no tax on when we take it out if we do it properly. And that's really the key, is working with an advisor who understands how to do this to make sure it's very simple to do, but it has to be done properly.
Very well said. As you were describing that, my head went to HSAs, self spending accounts, right? I mean, so those have a purpose, which is to help us, take some of the bite out of medical costs, right?
Yep.
But they also give us this bucket that we can, overfund, if you will,
Hmm.
with dollars that can come out tax free, and it's kind of what we're talking about with life insurance, right?
Yeah. Yeah. Very
Yeah,
similar. But the numbers are much greater.
much greater.
Um,
Yeah.
yeah. And I think I would just say this. If someone is interested or piqued by the idea of a Roth IRA or a Roth 401k, then they should look into what life insurance provides because it's very similar. It's not identical, but it's very similar with an advantage. The advantage is they get an instant estate. If for some reason they were to pass away early due to an accident or some unforeseen sickness, that 401k, or that Roth IRA only has in it what has been put in it, where the life insurance is kind of a self-fulfilling estate. It might have $1 million or $1.5 million that the family could receive right then, even if retirement hadn't been achieved. And then the other thing I mentioned briefly, which I think is really one of the crown jewels of this strategy, is there's no market risk. So when you're in a Roth 401k or a 401k in general. My dad's a great example. My dad retired on December 31st of 2000. In January of 2001, he lost about 25%, I think it was, in that first couple months of his portfolio because of the tech crisis or the tech bubble bursting. And so with this strategy, the 401ks, if you're in the market to get the growth, you're going to also bear the risk that the market has. And right now with where the market is, I mean, it's been on a tear, but nothing goes up in a straight line. And so during these correction cycles, the client's not going to experience that and can actually have some pretty nice rebounds, but never going below where they were the year or two before.
So I gather we're talking about IULs, right?
Yep.
Index Universal Life. That's where you get the upside with the no downside situation. So if I'm an advisor and maybe I haven't played in that space very much, and so it's a lot of things. If you're not familiar with it, it looks cumbersome, it looks awkward and janky, right? And so what would you tell advisors who can lean into this concept of creating some tax-free income, but are a little bit standoffish to the life insurance process? What would you say to them?
I think the first question I would ask, and I would ask it as I'd ask them, but I would actually maybe ask you to add more color to that. And the question would be, what is it that you're afraid of? Like, what is it that you're hesitant about in that space? I have a couple ideas, but why don't we have that conversation, maybe even, role play a conversation for the advisor, be that advisor for a minute and maybe push back on me and let's just have that conversation.
Sure. I think that there's two buckets of concerns that I hear from advisors, and that my DNA is financial advisor. For 3 decades, I've been a CFP, RIA, built and ran one of the largest branch offices at Osaic, and my wife and I started our own boutique IMO. So I'm really familiar with the space. For me, I think there's two areas. The first is the mechanics of the life insurance
Okay.
thing, right? I mean, it's a lot of paperwork, and I know we have EAPs now, but then you got, underwriting, and you've got, medical and financial and all that kind of stuff. All right. So that seems like a lot of paperwork. Coming from a securities background, I know that sounds like a strange observation, but
No, you're right.
still, yeah, it seems cumbersome. The other piece of that is the unknown about life insurance policies. I mean, they're a little opaque. You know what I mean? Hypothetically, when you get into the illustration of the contract, you're supposed to have all the moving parts laid out there and be able to see them. But honestly, I'm pretty bright, and eventually my eyes start to glaze over when I'm looking at that stuff. So I would say that those are the two areas. The opacity of the life insurance policy and the process. And I
Right.
know there's been a lot of progress made to address both of those issues to make life a
Sure.
little bit simpler for advisors. And one final note. So I think most of our advisors buy into the notion of trying to get more out of their business and spending less time doing it. So that's kind of the lens that we like to
Yeah.
look at things through. So what do you think?
Well, the one I thought you would say, really, I actually thought you'd say, well, really just one of the two, was the process. I think, for an advisor who's in the securities marketplace or an advisor who's in the annuity marketplace, it's pretty nice because it's just, you know what you're getting. You sign a couple forms, there's no underwriting process. And really, I don't think the forms are so much longer. But the process is longer. It's the underwriting process. And I think what gives a lot of advisors pause, and I understand that, is I might do all this work and they may not qualify, or they might qualify for something different than what I rated them for. And I don't know that they want to walk through, or that's what's kind of that gate or the barrier causing them to want to enter the space. Well, let's address the other one, talk about that, and then I'll sort of address them both. The other is, like you say, the opacity. I would say that's better than it used to be. I mean, I think companies, especially with the regulations that have come about in the last couple of years, everything is incredibly transparent. Now most people aren't going to read the illustration, but all the details are on there. But what I like to say to clients, and what I like to remind clients, and what I remind advisors, is I'll say to them, all of the fees and expenses and charges and everything that is in here, if you want to read it, it's detailed and outlined for you. But the beautiful thing with this illustration is the numbers at the end of each year reflect those. So what I want to do for you is every year, I want to come back, and this is where I said to advisors, they need to have those reviews. Every year I want to come back and I want to look at, here's where we projected it might be, and here's where it actually is. And let me tell you this, Mr. Client, I can guarantee you one thing, it's not going to be what's on here. Could be more, could be less, but we're taking one projection and running it for the next 30, 40, 50 years. And that's not realistic. But we're using a realistic average. And so anyway, with that, I think if we tell them that everything is built in there, it can alleviate that opacity because it's all there in the numbers. So I say, let the numbers speak for themselves. And one of the other things I like to say while I'm on that topic with it is, someone might say, if you use that same amount of money, you'll accumulate a lot more over here, usually a securities person. And I'll say, that might be true. But what you accumulate doesn't matter. It's what you can distribute that counts. And so when you're able to access money without having to pay tax versus having to pay 50, right now in California, top tax bracket, 37 plus 13.3, they're at 50.3 in California, and we know the likelihood of where that's going to go. That's with relatively low historical 100-year tax rates. You need to have half as much accumulated in that scenario as you do if you're going to be taxed at that level. So the opacity, I think, helps us out. For the underwriting standpoint, I guess I would just say this. They really have streamlined it a lot. A lot of people think of that one time or that exception. But the reality is, don't manage your business. Or someone said to me early on in my career, like in year one, 33 years ago, Patrick, I'm going to give you a key piece of advice, and it's been great advice. Manage your business for the rule, not the exception. A lot of people get scared because of the exception. Well, there's one time or what if, but the reality is 80% of them are going to go through just fine. It's part of the process. But let me ask you, if you could double your business, double your revenue, and not see any more people, but just work with the ones you have and expanding your offering or working with the next generation down, is it worth having that take a little bit longer? And I think in most cases it is. I actually think, Jack, it's fear. I mean, I just think it's fear of the unknown. Like anything, until you do it once or twice, it is a fearful thing. But once you do it once or twice, I think you're going to alleviate a lot of that.
I agree 100%. And I think that the tool set's a lot different today than it was even 3 to 5 years ago
Yeah.
with respect to the life insurance A process and B analytics. There are tools now that literally will go into the cloud and pull out the data and bring it back and lay it out in front of you so you can objectively see here's policy A, B, C, D, E, and here's based on similar assumptions, similar kind of moving parts. Here's what the expectations would be, and so you can start to get a little bit. You can start to get your arms around it a little bit more. So one of the things that helps overcome fear is having an impact. And we've talked to our advisors about the fact that they have three pillars to growth if they're going to expand their practice. They got to retain their clients because that's where they're going to get referrals in the future,
Yep.
increase share of wallet, and then attract new clients, right? So when you start to think about where this tax-free retirement thing kind of fits in, I think you alluded to this earlier, and that is that it kind of stacks on. If you kind of maxed out your IRAs and your Roths and the rest of it, then if you still got more money, then that's the place to start looking at the tax-free retirement account, right? And to me, what you just described is the ideal client. The client who's got lots of assets that I don't have now that I would like to get a greater share of wallet for. Have I got that about right?
Yeah, but the one piece that I think I would add on to that I think if advisors in the annuity space as a whole, they're missing one key massive opportunity, and that is the next generation. If they're working with parents, and if they're working primarily in annuities, they're working in the generally 55, 58, 60 and up market. Well, that 60 and up market has kids that are 35 and up. And that is the sweet spot for the tax-free retirement strategy if you can do something when they're 35, 40, 45. And these are people that are already working with the advisor, trusting the advisor. So one of the things, and then you talked about your third point about attracting new customers. An easy way for them to do that is actually to utilize the book Tax-Free Retirement as a gift to the parents they're already working with to give to their children. So use your current client to just get this little, and I had an advisor tell me once that book was like having a full-time employee in someone's house 24/7 that they didn't have to pay a salary to, because it was telling his story for him, without having to cost him anything. And some will get read, some won't get read, but utilizing that strategy is an easy way if they're not comfortable saying, hey, would you give me your kid's name so I can call them, But hey, I have a gift for you to give to your kids. And it's an easy way. Obviously, put your business card in there and you maybe write a little note. I work with your parents, and this is a book I thought you'd enjoy, so I asked them to give it to you. That can fulfill the second and third tiers of what you were talking about, expanding on the current client relationship and also bringing in a new group.
100%. Yeah, we've talked a fair amount about that. I mean, Gen X in the not too distant future is going to have a bigger pool of investable assets than the boomers do.
Yeah.
And it's a little shocking to people. But if you start thinking about Gen X, they are, on the outside of 50, 50-ish, closing in. They're still insurable. Okay, so that's a good thing.
Yep.
They've got, a runway so that they can sock money away.
Yeah.
We've talked about using Social Security planning with them because they can do the Social Security planning strategies, like building a bridge and those types of things. So, and buying the insurance for the widow's penalty and all that. So, Gen X is a great target audience, and this fits right in with them. Absolutely.
No, absolutely. Agree 100%.
So, how so tomorrow, after listening to this podcast, what would you suggest, are a couple of steps one of our listeners might do, to really start to make this opportunity real in their practice? What should they be doing?
Well, I would say, and I will refer back to you for a piece of this, but one of the things I've found, and really what I've spent since 2007, so the last 17 years, a good portion of my time has been spent, training, coaching advisors, instructing advisors, putting materials out there that help them understand. Because what I really found, even as I talk to agents that have been doing this, I have story after story. I won't bore the listener with it, but some fun ones of advisors that have done this their whole career, but really didn't understand the power of the product they sell. Well, I will tell you, I remember being in one of my early seminars as I walked through the power of this strategy, how you present it to a consumer. And there was a brother and sister sitting side by side, and I asked the brother, it was sort of a feedback, interactive time, and I asked the brother a question, and he just sort of sat there blank. And it wasn't blank. He was just like in this own little trance. And he finally looked up and he goes, I can't believe this. I've been in this business for 12 years and I had no idea how powerful this strategy was. I'm just kicking myself I didn't do this 12 years ago. So I would say step one, and there's a few ways we can do this or you can do this, is really understand the power of this strategy. And quite frankly, Jack, back to the original question, if an annuity advisor maybe they're just comfortable. They don't want to work any harder. I'm going to propose they don't have to work much harder to incorporate it into their current practice with their current clients. But if they're not utilizing it, it's because they don't see how powerful it can be, not for their income, but for the client's future retirement or future wealth. And so they have to convince themselves first. And the only way to convince themselves first is to really learn it and understand it. It's not going to take a long time. And there's a few ways they can do that. Obviously the book Tax Free Retirement, that's why I wrote it for the consumer, but if the advisor himself or herself isn't using it currently, that strategy, I'd say they don't really understand the power of it, and that book could help them. I've created a whole suite of tools and videos that could help them, but for you, within your group itself, my guess is you provide opportunities for that kind of training where they could, tune into whoever they're working with and say, I want to find out how powerful this strategy is. Who can I talk to? What can I look at? Point me in the right direction. Because I really do believe, passion comes with conviction. And once they see both what it can do and also see what the crazy reality is of future taxation based on where we are today, I think, if you saw someone drowning and you were out in the boat in the middle of an ocean, you'd be pretty, passionate about helping them and saving them and getting them out of the water. And I think for a lot of these customers financially, it could be similar. They could be in a real deep trouble. They may not even know they're in trouble yet, but if we can help come alongside of them and not scare them, but just say, hey, here's what could be coming. Are you prepared for that? I think education, understanding it, will create the passion.
Yeah, I agree. I think you do a great job articulating that.
Thanks.
So before we wrap up, so what are a couple of things that Patrick Kelly does when he's not talking tax-free retirement that might surprise our audience?
What out of a surprise? I can tell you what some of my, well, actually one would surprise. I do some car racing. So I do enjoy, it's been a passion of mine for about 12 years, different levels and different parts around the country. So spend a bit of time at the track. And that's one. The other is I am equally passionate, maybe more about cycling. So I've ridden since college, although I had an injury, so I had a pretty big gap of break in there, but certainly gotten back on the bike. And over these last couple of years, I've taken up mountain biking, which has been more hazardous to my health than road biking has been. I think road biking, the consequences are fewer but more severe because of the cars. The mountain biking, much more frequent, not, but I managed to separate a shoulder pretty good last year. And so, yeah, I like sailing. So I'd say sailing, cycling, and some auto racing.
Yeah, I think the sailing's probably the safer of the three, which is an odd choice, right?
Depends how far off you go, but yes, I know it is weird when sailing is the
Exactly.
safest.
Exactly.
Okay, I
Exactly.
like adrenaline.
Yeah, exactly. Hey, this has been a great conversation. I enjoyed talking with you, Patrick. Hey, folks, please share, subscribe, and like the Breakthrough Advisor podcast. There's connection information about Patrick Kelly in the notes with the podcast. Feel free to make those connections. Reach out to your advisor development consultant at InsureMark. They can absolutely help you get connected with the tool set that we've talked about and with all of the content and support materials. The time is right, for a lot of reasons to take a good hard look at this if you haven't added it to your portfolio. So Patrick, thank you very much for joining us. Super to talk with you again. So on behalf of the Breakthrough Advisor podcast, folks, I want to sign off and say, wish you a great week. Good luck and good selling. Thank you.